Okay, guys, thank you for being here. We're here today to talk about DePIN Tokenomics. We've got two of the world's foremost experts on that subject here, and Robert is joining us as we speak. So, yeah, really excited to chat about all this. Brief intro on myself. My name is Connor Lovely. I'm the founder of Proof of Coverage, which is a crypto-native media firm, and I've been very involved in the DePIN sector since 2020, so the early days with the Helium project. So, guys, without further ado, let's start with Dylan and give us a quick intro on yourself and then, what you're doing to contribute to the DePIN sector, how you're involved.
Hey guys, I'm Dylan. I'm an research analyst at Messari on our enterprise team. I cover primarily DePIN, as well as infrastructure, and adjacent spaces. And yeah, I write DePIN research. We released a DePIN Tokenomics report along with Robert about a month ago. And we're going super deep into this topic.
Great. My name is Tom Trowbridge, co-founder of Fluence. Also help host these DePIN days, host a DePIN podcast as well. And I have, we spend a lot of time at Fluence thinking about our token economics, and I've got a report coming out on the topic as well. So stay tuned for that.
Yeah, hi, I'm Robert. I'm with 1KX and head of economics, so do a lot of token economics, economic designs, and modeling. But yeah, DePIN is a topic I've been researching for a couple of years now even. And yeah, basically always taking the lens of like what's going on, how are DePIN evolving, and also how their tokenomics are evolving. And that, yeah, as Dylan said, just published a report and will publish even more.
Yeah, I think all three of you probably published even specifically DePIN tokenomic reports. But Tom, I want to start with you since you've probably done the most thinking on it recently. How would you say DePIN tokenomics specifically differ from tokenomics in other verticals of crypto like DeFi or AI or anything else?
I mean, I think the way I think about that is that there's a way they differ, and there's also where the maturity is. And so DePIN is generating real revenue, and that revenue, when architected in the appropriate token economics, gets directly attributed to the token. And that is a hard thing I've seen or the link that has not been as clear in other crypto kind of verticals or protocols. And so there's always been a debate in crypto as to how is success and traction manifest in the token. And so you would like to, for example, you look at Ethereum, and if Ethereum was 10x the amount of transactions, what would the token price be? No real way to model that, right? And so you can argue it'd be higher, but there's not a clear, specific link to that. And I'd argue the same with like a Solana as well. And so I think in the way I sort of joke is that almost everything in crypto is a meme. It's just a question as to how, is it 100% of a meme, or is it like 80% of a meme? And with DePIN, if you have certain economic things like a buy burn, then you can actually take this revenue, buy 80% of that worth of that revenue in tokens. And that's something that you just don't see in other, in there. I'm sure there are a couple of exceptions, but generally across the crypto ecosystem.
Tom, how do you think about, or did you articulate any new, say, like theses or ideas in that report? I know it's not published yet, or were you more trying to like make sense of what's already gone on or say things?
Yeah, I'm just looking at the landscape overall, but I'll tell you, there's a lot of new things there. And so, there's the concept of medallions, for example, right? And so medallion is a concept that's, I think, pioneered. I know Daylight, I believe, is talking about a couple of others where they basically use crowdsourced economics to figure out what market makes the most sense. So like, where do we move next? Well, let's let the crowd bid for these medallions. And then the value of those medallions effectively tells the project where the most economic activity is expected to be given its universe of buyers. And so that's like that's not widely deployed, right? That's a relatively new one. I didn't make it up, but I think there are certain elements along those lines that I think are interesting. And DePIN is kind of one of the kind of forefronts of different crypto economic design, I would say.
Robert, for you, you've done a lot of modeling on DePIN tokenomic systems and how they work. Like what tools would you say you use, or like what strategies do you employ to model out how tokens will flow in a token economy, specifically with respect to DePINs?
So yeah, I mean it's pretty plain economics 101, I would even say. because as Tom said, right, like the unique economic, the tokenomic aspect of DePINs is that it's physical infrastructure, so you have like real world cost. It's real world revenues because somebody likes to store their data, somebody needs the weather data or whatsoever. So somebody's paying also for that. And this is the thing where you can easily then model and simulate the flow of like, okay, this is how we incentivize the supply. So this is how much token we go out. This is the revenue we anticipate and these scenarios. And then, yeah, you have these various like Python agent-based modeling techniques that you can run through to then, set the various parameters of like, okay, how many incentives do you think you need? But yeah, the main ingredient is really just have a good understanding on your revenue trajectories, your cost trajectories, right? You should understand how much does it cost your suppliers to basically supply the storage or the stations or whatever you need. Plus also the adjacent cost. You typically have a blockchain where your accounting runs through like the payments and the work that has been done. And all these aspects you can just like plug into a model, run simulations, and then tweak your token model.
Yeah, how do you guys think about advising DePINs on what to do with the speculative premium that often gets placed on top of the token's fundamental value, right? Like we're in crypto, we're in a very early stage sector. A lot of times these tokens will float at 100x, 1000x, their earnings or anything like that in terms of fundamental metrics. So how do DePIN and DePIN founders combat like the kind of craziness that can happen with token price? I mean, it can obviously help their projects, but also hurt them. So how have you guys advised them on handling the token premium?
So one thing that I do, and I know Fluence does it also this way, is for sure when you do tokenomics designs, you want to separate the roles. Like, okay, this is guys who just supply compute. This is our blockchain, and we need some validations, and we also need to pay for that, and various other roles that we might need to incentivize. But on the supply side, in the past, because we wouldn't know any better, Filecoin, Helium, the very first ones, they would just say, here, we give you token because we don't have anything else. What happened? We saw this crazy 2021 boom, and then boom, they handed out basically millions of dollars for something that costs like a couple of thousands, right? So basically overspent. Now in the bear market, that went the other way around because all of a sudden the token is worthless, and then it still costs a couple of thousands to run the machines, but they get a couple of hundreds. And that's why one core concept is like, if you know the cost, and especially in this digital resource networks where, it's more like a monthly OPEX that you can estimate or have a good understanding, just make it dollar-based, what you incentivize them and what you pay them. You can still pay them a token, but just tie it to the dollar notion. Obviously, that is not the solution for all DePINs, but it's for sure something I start typically to just say, okay, how do you feel about that? We typically start with the question, what are the costs? Which then more than often you'd be surprised that people are like, I don't know.
Yeah, so denominate things in dollars. Tom or Dylan, do you guys have anything to add there on that speculative premium on the token and what DePIN projects should do about it?
Yeah, I would say it is an issue. I think less of a recognized issue when markets are doing good and your tokens going up, and then as we kind of see right now, all tokens go down, and then you kind of have to rethink your entire tokenomic design. I also think it depends on how you structure your tokens. So like we can look at a very experimental protocol like Glow, where they have a fixed issuance mechanism where there's, I think something like 200,000 tokens emitted every week. If the token price goes up, that's great. That means more people are going to compete to get that limited amount of tokens. They're going to deploy more solar panels, more infrastructure. Solar panels in particular, once they're built, basically always profitable. Most of the costs are upfront. So if you get that done, that's great for the protocol, and that speculative premium is great. What you just have to hedge for is what happens when token prices go down, and how do you provide basically a floor where there's enough of an incentive mechanism, irrespective of crypto markets, where you're creating real world value based on real cash flows, and you can continue your flywheel effect to continue growing your DePIN. So I think it depends on the model. I think you can find a way where you benefit from the premium, but also you can stabilize things when markets are down.
Yeah, I agree with everything that's said. To take Robert's point, to emphasize one piece there, people are always worried, as Dylan said, about the risk of the token price going down, and that's a risk that everyone is kind of very conscious of, especially now. But as Robert said, token price going up creates other problems, other issues. You also, besides what Robert said, you attract other providers that may be temporary. You attract more fraud. You attract fake users, right? And so then you run all kinds of other risks in your network if you're paying out massive rewards that have massive in the fiat level. So that's what we saw in some of the projects you mentioned, obviously. And so you've had Helium go from 1 million hotspots down to 300,000, right? And you've had, Filecoin miners, a huge number, also decline as well. The one point I also want to make on the speculative premium, though, I think it's interesting, is my thesis, and I'm sure you guys share it, is that buy burn is going to lead to significant value and token appreciation as projects generate revenue. So projects generate revenue, they use pick a geo, 80% that goes to buy burn, right? So now you've got a solid demand for that token. No one else needs to buy it. And now you've got a real support for that token. But what happens next? Well, investors see that. And investors are like, oh, this is great. And so what happens? That project will get bid up even more. And so I don't think the speculative premium goes away at all from this. I just think those projects now will trade at a premium and be subject to the same volatility of everything else, but just maybe at a somewhat higher level, given the buy burn dynamics.
100%. And I'm glad you mentioned GeoNet, because with the markets being super ugly the last few weeks, like their token's been up. I think they're up 15% today. Just announced a big round led by Multicoin, and definitely hats off to Mike and the team there for building through the bear market and really just, I think, pushing the space forward in terms of getting revenue into the system, but then also accruing it to their token and doing so very clearly on chain. It's like all tracked by their Dune dashboard, which has been great. Something I've been thinking about recently is the segmentation of DePINs into whether they're enterprise or retail facing on both the supply and the demand side. So your contributors and your customers, how do you guys think about, token incentives for the supply side between DePINs that are looking to attract like a retail audience of people maybe contributing with their mobile phones, like Helium mobile mapping, for instance, versus DePINs that are interfacing with, enterprise scale contributors on the supply side in terms of like entire data centers, and there's more of like a B2B relationship. How should their token economics differ between the two?
So yeah, I think like you said, I think that's a good way to segment the demand side or and the supply side. I think buy and burn, like we see with GeoNet, works really well with B2B sales. So just having a gateway foundation or company basically sell the data and then burn a percentage of that after they buy back the native token. And I think one of the limitations we saw of DePIN in the early years was just they don't have sales and marketing. The end client on the demand side doesn't really know what they're buying, and you really do need that. So I think a buy and burn model makes sense. There are obvious issues with centralization. I think it's worthwhile just getting that revenue going, getting your DePIN flywheel in motion before worrying about decentralization down the line. I think for retail, I think Helium has a pretty good model with burn and mint. I think you need less of that enterprise sales. I think the value proposition's different, and I think you can be much more decentralized from the get-go. You can also abstract away the crypto element, and you might want a gateway company there. But I think I haven't seen as many issues on the retail side versus the enterprise side that we've seen with file storage and compute in particular.
Yeah, not much to add other than, you really want to start from like your users and enterprises users. They have, obviously like a little bit more higher demand. Talking about SLAs. I mean, if you talk about storage, right, there's even other things they need to comply with. Otherwise, they can't use your product. And this is then on your supply side something you need to just organize, which is then something typically you cannot source that like from retail, right? I mean, you cannot basically say, oh, I have enterprise customers who want to store their data, and I source this from like all random people across the globe. This is, I mean, this might work. I haven't seen it, but this then obviously impacts the way you structurally set up your network. So this is like, then you have also more professional providers on your supply side as well. And that's then something where on the tokenomics side, you can obviously set different focus, right? Where it's not so much on the mass, but on the quality and also reliability, and also kind of like more long-term relationship, which then you can reflect in token mechanics like longer-term staking, longer-term lockups, things like that, how you basically bind the supply that basically is more partnership. Whereas if it's more like retail focused, and take, for example, the grass, where you just have a browser client that you run up, I mean, you give them a cent or a penny or whatever, it's low incentives, they can do it. But if they go away, somebody else will show up and do it. So you don't need this like quality and like binding partnership type of relationship that you did need with, for example, the first example I made.
Yeah, and I think I just emphasize the grass bit because what I believe they have the most providers of any DePIN protocol. I think you got 2.5 million people sharing bandwidth with grass. And they did that by doing the multi-layer marketing, right? Where you sign up, you get X. You sign someone else up, you get 20% of them. They sign someone else, you get 10% of that, right? So you marry multi-level marketing with crypto, and boom, you've got this explosion, right? And so kudos to them for figuring that out and executing it out, incredibly quickly. But to Robert's point, that's not going to work if you're trying to onboard, tier 4 data centers and institutional providers. That model does not work. But for the retail stuff, I mean, good for them. And they've got a powerful, huge network. They're the most users of any DePIN out there, right? I mean,
definitely. And Tom, given you're the only protocol founder up here, could you give us just a really high level overview of how the token is used in the Fluence kind of system? So both on the incentive side and also on the demand side.
Well, yeah, I mean, and this Robert kind of touched on this before, but we use Fluence to secure the network. So a token is staked to our compute or to our CPUs, and that is how people can trust those CPUs. But the distinction there is it's $12,000 per CPU in our token. So tokens $1, 12,000 tokens 50 cents, it's 24,000. And then rewards are paid. Again, we're trying to get tier 4 data centers who have fixed costs, and we want institutional providers. So we pay $10 per core in our token. So token price moves around, your reward number of Fluence tokens moves around, with the idea that we want providers who are happy to sacrifice kind of some moon potential for the downside protection of having a more predictable stream of returns. And so to cover their costs. Now it also vests over 6 months. So it's not a one-to-one. You still take token risk. You just take a lot less than if it was an arbitrary amount of tokens. And so the concept is, in theory, once you start the flywheel going, more staked, token goes up, which means you pay fewer tokens and rewards because it takes fewer tokens to make that $10, right? Which means then it's less inflationary, which means token goes up more, which means you're paying less. So theoretically that works out. It can also work on the downside though, where token goes down, you got to pay more rewards. So, it's not, there's no perfect model out there, but we just designed it specifically to try to solve the problem of what would attract institutional providers to our network and what would they want. And so we spent a bunch of time talking to people about that.
Got a question?
Kind of following up on that, you're talking about the volatility of a token, but what if someone builds like a DePIN stablecoin, or we try DePINs for stablecoins, and we do the proof of work being done with the hardware devices, we tie it down not to the token, which can be volatile, but with the next to a stablecoin, which
I mean, that's the question is something about, could you tie a stablecoin to compute produced or generated or used? I mean, yeah, I'd love these guys to find that. My view is that's certainly possible, assuming that you appropriately predicted the cost of that compute that you were talking about. So that to me is just a proxy of some premium over the cost it takes to do that. So assuming that's the case, then that makes sense. But then it's also, is it that different than on the fiat side? I'm not sure. I have to think about it a bit more.
Yeah, but it's a valid question that any founder has. Like, okay, do I need a token or can I just run a stablecoin? And there are DePINs out there. I think Spexy runs on UCC, Glow I think as well. So it's not that uncommon to do that. Obviously, if you have your own token, that has some benefits as well because it's you give out basically part of your company as shareholder basically, and that has a lot of. I know a lot of node operators that are particularly interested in basically providing services to you, basically granting you the credit of their OPEX expenses in dollar. They eat that because they believe in your protocol. And when the token goes up, then they basically made way more money than they would get when they just do fiat based, right? And this is then typically the reflexivity that helps protocols. But yeah, as we alluded earlier, it can also go in the other direction. So yeah.
Yeah, I'll add, I think a lot of infra providers, node operators are kind of what we call venture miners. They want that asymmetric risk from being an early contributor. And it's much harder to bootstrap a network initially if you're just using stable coins, linked to like USDC. And yeah, you have the same Web2 problems then. So it kind of defeats a lot of the initial purpose of DePIN to do so.
Yeah, the conversation just naturally segued to this pretty beautifully, but let's talk about another utility for these tokens, which is governance. How much say in a DePIN's kind of development do you think the contributors in the community should have? Should that change over time? A lot of these DePINs will start more centralized and then become decentralized over time because nothing's going to get done in the beginning if it's fully decentralized. So what are your takes on governance and token utility for governance in DePINs?
Yeah, I can go first. So governance, when we design tokens and do economic modeling, is something where I would say always like this should be, it's a sequence and that should be further down the line of the sequence. That is not to say you don't do it. It's just like it creates just an additional layer of complexity to arrange that, because when you launch your own token, you already start with the question, oh, do I even use stablecoins or do I use my own token? And then when I use my own token, how do I incentivize? How do I balance supply and the cost they have and the sell pressure? And then you add on top of like, okay, if somebody has like more than 50% of my token supply for whatever reason, what can they change via the governance? Like they overtake my company that I built. So this is a complexity that you have. And that's why I would say, okay, park it for a while. Even though what I like the most is to think through, okay, the emissions you give, which typically is a lot for your supply side, which means these guys naturally, if they don't sell, gain power in your network. And that's why you see a lot of DePINs actually don't have this like DeFi-like approach of governance token where it's just like, okay, if one token, one vote, right? You have different models, whereas Pocket has like a different mechanism. Filecoin or the Graph, they have councils, committees that take the input from the community, or Akash also an example, and then have sort of like you need the token to give up proposals, but then there's still like additional layer which main use is to protect from any attacks, and then also let's not forget it's also most DePINs are very, very early. And in the beginning, decision making, you want to be fast. And there you kind of like want to also use more streamlined execution when it's just a founding team moving forward. And eventually then you can decentralize your management.
We did the hard way at Fluence where we launched from a DAO from day one. And so we are governed on chain via DAO. That's the harder thing to do. But the DAO engaged the company to do the marketing and do development. So we sort of, while that contract is live and it has to be renewed by the DAO, we still have the ability to move and execute quickly. The other point I think on this is that, Robert alluded to as well, we have a governance council that can override DAO votes, but the DAO every 2 years votes for that committee. So effectively this council is a brake on the DAO, but it cannot prevent the DAO from doing something in perpetuity. It's more to prevent kind of rogue votes, if you will. But ultimately it gets voted in every 2 years, so it cannot kind of thwart the will of the community in perpetuity. But we still obviously have have risk with that. What we don't do are the complicated voting structures Robert alluded to, quadratic voting to reduce the power of the top token holders, or stake. Some projects, the longer you stake, the more your vote counts. Like, I think some of those are super interesting. We haven't done those, but I'm interested in a lot of those.
Yeah, I think also you can decentralize certain functions. So like one example I like is, how do you expand coverage for a network in like very high value areas? So like GeoNet, they have a more governance structured framework where they have basically their philosophers decide this is a high value area or hex, and we're going to activate a multiplier. So it's very governance centric. And then something like medallions, which you've touched on, this is more market centric, where someone with local expertise can say, I want to stake tokens, I want to mint a medallion and put it on this hex or area, and that's going to activate the rewards. So this is driven by markets, by economics, by anticipated profit versus governance, just making a decision based off votes. So I think like there's functions that you can choose to make more decentralized. It's not like everything needs to be decentralized right now type of question.
What do you all think of DePINs going multi-chain? This is a trend that I've seen a lot this cycle versus last cycle. Some DePINs will even launch at the same time concurrently on multiple chains, or they'll eventually expand to one or two additional ones. So what do you think of that practice? Is it a positive or negative typically? And how does going multi-chain impact DePIN tokenomics for a project?
So first of all, let's appreciate that it's really nice to have these opportunities. The very first DePINs like RV Filecoin, they don't have that, and they paid a lot of money to spin up their own chains. Not to say that today you can still run your own chain if you see fit and need for that. Overall, I would just say, I mean, it depends on why do you do this, right? If you do this because you want to have the liquidity across chain, well, then yeah, do that, right? Like, I mean, if you believe that, but in the days of chain abstraction, I don't really see why you should have that. Just have a big pool on Ethereum, and all the integrations will follow, and you just need to have liquidity where the investors are. And if you need these different chains because your users need that also sounds like weird UX, because why is that? Why can't you abstract that away? So long story short, I feel like, yes, you can roll out your infrastructure on various chains, but I would ask like, okay, that sounds complicated, and it sounds more complicated than it should be. So I would really challenge like, what's the reason here to do that, and really see if you can simplify, because even though it's cheaper to run on Solana base, whatever, it's still a cost, because eventually also pay the developers. But I'm not sure. You don't run on Solana.
Here's because we're actually thinking about this ourselves. So here's the thought. Like, it was the ERC20 is Fluence, right? But there's a lot of DePIN projects on Solana. And so what I don't know is who's looking at DePIN on Solana, looking at their wallet and being like, okay, what other DePIN projects can I buy? I'm not going to go to MetaMask. I'm not going to change wallet. It just is like a simplified potential purchase. Again, I'm not sure about this. I have no idea the scale, if it would make a difference at all for us, but I intuitively think there is some liquidity benefit to that and some access benefit. I cannot quantify it. And so I don't know. But if you fast forward to a year where you have 2 years where you have a huge amount of DePINs that are on Solana and you're not, do you suffer in terms of your liquidity and token buyer universe because everyone's just working on using the Solana ecosystem? It's a possibility. I don't know.
Yeah, I think if you look at like DeFi, it's usually protocols of product market fit, clear product market fit that go multi-chain. So like Uniswap. I'm not sure if we've seen too many DePINs so far that really at that scale where they'd need to tap into more liquidity or try and grow through, they've exhausted their current chain base. I think like another approach is also, I think like Polygon is like talked about partnering with like IoTex to do like an ag layer type thing where you can like aggregate across chains and get liquidity in that way. So I think it's really a matter of, is there product market fit? Is it worth going multi-chain? And then also maybe it'll just be an easy way to do that down the road.
Awesome. Well, guys, time is up, but thank you for joining me, and thank you to everyone in the audience.